Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Elconin, along with Brianna Valesky, and we have Adam Sarhan on the line. He is founder and CEO of Sarhan Capital. Good morning to you, Adam.
Good morning.
Thanks for coming on, as usual. Well, let's just do a little market talk here. A couple dips over the last few days, a couple sharp rebounds. I guess pretty well-defined trading range here. And when we started the show, and I don't know if it was you or one of our guests last week, we were talking about, being afraid of the market or worrying about the market go down. And maybe it was you that made the comment that when the market's going to go down, it's going to kick you in the teeth a couple days and it's going down. But until it does, and was that you?
Very well said.
Was that you that had those words of wisdom, or was it someone else?
It might have been some. I don't want to take credit for kicking in the teeth, but I wish I could. That's very, very well. It's a great way to describe how the feeling is when the market goes against you.
Okay.
But I definitely have talked to you about sentiment in general. As you guys know, psychological analysis is something that I developed. I coined a term in addition to fundamental and technical analysis. So there's a very big possibility I could have mentioned that in the past with other language. But absolutely, when the market goes against you, human nature is almost programmed to do the opposite of what's required to be successful on Wall Street. So there's an old adage on Wall Street which says, be fearful when others are greedy and greedy when others are fearful. And what does that mean in plain English, so people to illustrate the actual in real time? What it means is, let's say, for example, you buy a stock at 100 and the stock goes down to 95 and then it goes down to 90. What the gut reaction for most people is to be greedy and hope to get it back to even just so they can sell and not recognize a loss. Few things that happen there. Number one, they allow the loss to get bigger, so that they do the exact opposite of what's required. Instead of limiting your losses, letting your winners run, they let the loss get bigger. Number two is they don't want to admit that they're wrong, and that's why they do everything they can to defer taking a decision, even though that they're out of the money. So they attach themselves to the trade, which is a real big problem that a lot of people do. They allow the trading to affect their everyday emotions and their mental well-being and all that fun stuff. And then the other problem there is that when you say buy it at 100, let's say it goes up to 101 or 102, 105. Most of the time, people are fearful that the gains are going to be erased, so they'll quickly take the profit. So essentially what they're doing is the exact opposite of what's required to be successful on Wall Street, is that they're limiting their gains and letting their losers run. Even if the loss gets to 50% below their entry point, it'll come back. I'm just going to, once it gets back, I'm going to sell it and break even. The problem is simple mathematics tells you that's just a devastating system. So if you buy a stock and it goes down 10%, you need an 11% gain just to get back to even. If it goes down 25%, you need a 33% gain to get back to even. If you buy a stock at 100, it goes to 50, which is down 50%, you need a 100% gain just to get back to even. Now, the real question is, how many times do you see a stock go up 100%? The real kicker is how many times you see a stock go up 100% after it fell 50%. And therein lies the real crux of why most people have a hard time getting ahead on Wall Street.
And just buy and hold is a lot better. And not just also from short-term trading and investing too. A lot of times if I have a large position on, the what I make the most money on is the last, 100 or 200 shares, because you don't think about it. You're not worried about it. You keep moving the stop up. And that's a really good point. Well, we had a really nice rally going on this morning on the street. Got up to 1975. We're peeling back pretty good here, 6 points. Still just going to maintain that trading range.
Yeah, I think, let me just clarify the buy and hold. I mean, everyone's got a different strategy as far as buy and holding. I'm more of an intermediate term, so I don't want to say that I'm a buy and holder, because I'm not. I'm more along the lines of let the market guide me in and out. So before I get in, I know before I get in where I'm going to exit and how much I'm going to risk if I'm wrong. And we show everybody at FindLeadingStocks.com specific entry points in leading stocks before the market opens every week with exits. So what we do is we buy and hold as long as the stock's going in our favor. When the stock's going against us, we're out. So we can always re-enter, but we have our losses, limit losses, 3 or 4, 5%, 6% below our entry point, maybe 7 maximum. But we really don't like to let losses get any bigger than that. And then on the upside, we'll let the stock run as much as possible as long as it continues acting well. So it's got to pay us essentially to be involved. Now, with respect to the market, I think the equity market, stocks in general, look very, very strong. You're 1 or 2% below record highs for the Dow and S&P. I think less than 1% in both the Dow and S&P. Yesterday, the bulls showed up and defended the 50-day moving average for the Dow and S&P. The Russell yesterday jumped above the 50 again. It was living below there for a few days, if not a few weeks, but it's doing its best now to repair, so to speak, the damage. But even with the Russell, with all the damage that's going on over there, and by all the damage, it's only 3 or 4% below its all-time high at its lowest a few weeks ago. And now it's about 2% below its record high. The NASDAQ and NASDAQ 100 are flirting with their 2000 record highs. So it's really, once again, when you step back, look at a weekly or monthly chart in the S&P, any of the major indices for stocks, and you can see that the market had a huge run, and for the last 5 months or so, we've been basing, 6 months if you will, moving sideways to digest that move. Now, there's two things that can unfold from this sideways consolidation. Either it serves as a platform for the market to continue to break above resistance and begin a new leg higher. It needs a catalyst, whether that's the Fed either raising or not raising, or even cutting rates or doing another round of QE if needed, because the Fed said they're data dependent, right? So right now, literally, the Fed, nobody in the world knows what they're going to do. Even the Fed doesn't know when they're going to raise rates, if they're going to raise rates. And so far, the economic data continues to disappoint, and because the Fed's data dependent, and because the Fed's led by doves, it wouldn't be outside the realm of possibility to see another round of QE come in if the data worsens or gets, materially, it gets weaker. So whatever the case may be with the Fed, but the market is simply waiting, in my opinion, to see what type, any kind of clue of what the Fed's next move is going to be. And as long as it remains perched below record highs, to me it's healthy. Because there's another old adage on Wall Street said that the stocks or markets in general, take the stairs up and the elevator down. So meaning it goes up, moves sideways, goes up, moves sideways, builds stairs on the way up. Now it's just one of those sideways consolidations within a broader uptrend. Now, if this is a topping pattern, because we are 6 years into this bull market, and the last 30 years, almost every major bull market ended shortly after its 5th anniversary. But then again, rates weren't at zero. So that's a major variable that's into this bull market that hasn't been there before. But basically, if this serves as a huge topping pattern, we will see support break and then a new leg lower begin. But so far, all pullbacks in the stock market have been shallow in both size and scope. And that remains extremely healthy. And it shows you that there just aren't a lot of sellers out there. There are a lot more buyers right now than there are sellers. That's evidenced by the fact that the market refuses to fall.
I think you make a couple good points there. Number one, we are just in this zero interest rate environment. So before, when people were exiting the market, there were alternatives, to get some kind of yield on their cash. Now there's nowhere to go. There's nowhere to go
Exactly.
to get 1%, 2% yield. And it's almost forcing the hand of the investor and as well as the funds or anybody that's holding large amounts of cash is to, to go in. AT&T, Verizon, GE. Those are your T-bills. Those are your T-notes. Those are your
Exactly.
CDs. And it's scary, but
Well said.
that's really the only way to put it. So you went on there, you talked about monetary policy here. We have the unemployment number coming out on Friday. The ADP number was right in line here. Do you really think that there's going to be anything coming off the jobs report on Friday that's going to send the Fed one way or another?
No, I think so far this is another piece of the puzzle. In other words, Friday's jobs report, any incoming data we see now bearing a huge beat or a huge miss is just another piece of the Fed's puzzle because the Fed's told us they remain data dependent. So typically when you look at historical Fed moves, the Fed doesn't just do one move. It's a series, 6, 7 hikes or 6, 7 rate cuts. It's not just, hey, let's just raise rates once and that's it. So the Fed's got to be very, very sure that the economy can stand on its own 2 feet without the medicine. Think of the patient and the doctor kind of analogy. So assuming that the economy is a patient, when can the patient be strong enough to get off the meds? And right now the Fed knows that with rates at zero, That's very, very aggressive, by the way, in historic measures. But with rates at zero, the economy contracted in the first quarter. That's a fact. So it raises the question: if the economy can't grow with rates at zero, how is the economy going to be able to grow when the Fed begins a series of several rate hikes?
So is 15 off the
And
table?
that's the Fed's biggest
16
problem, just to
or
be
never?
abundantly clear.
2015, 16, never. I mean, what's your call, Adam? I know when
The call is it's data dependent. Anybody who makes a call is simply pulling something, a rabbit out of the hat, or just trying to shoot a moving target.
right.
By definition, the Fed's told us they're data dependent. So the good news is that you don't need to make a call, because early 6 months ago, everybody in the street was saying June and September. And then all of a sudden, the data dependent Fed, the data came in a lot weaker than expected. So June just disappeared.
Right.
Poof, it just disappeared. Now they're talking about September, December. Well, what's going to happen in 3 months if the data continues to be weaker than expected? Poof, September's going to disappear, and they'll talk about December or March, or whatever the case may be. They'll keep kicking the can. So the point is that as far as my call is the same as Yellen's. Not the last Fed meeting, but the first Fed meeting of this year, Yellen told us in her presser, she said, listen, guys, I want all of you, market participants, to interpret the data the same way we're interpreting the data. And that's exactly what we've been doing in our shop. That's simple. We do it for our clients as well. It's like, listen, we don't have to predict or make a call on when the Fed's going to raise rates, because it doesn't no one knows. By definition, the Fed themselves don't know. So instead of trying to make a prediction and make a moving target, we're going to continue to interpret the data the same way the Fed is doing. Imagine we were on the board of directors of the FOMC, and they asked my opinion. Well, that's exactly what we do in-house. And say, okay, what does this piece of the economic puzzle mean for the overall picture? If we were the head of the Fed, what would we do? Right? That's from my point of view, analyzing the Fed and being a market participant and looking at at all the moving pieces in this overall puzzle and connecting the dots. The biggest problem the Fed faces right now is that the economy is not responding well to extraordinarily easy monetary policy. And then the other central banks also, look, this morning, the ECB held rates steady. Okay, great. They're still having their QE. They front-loaded their QE a few weeks ago when they announced that, hey, we're going to be printing more money over the summer months just to keep stimulating the Eurozone economy. But today you had the OECD came out and said, hey, guys, guess what? We're going to downgrade the global economy. Even though every central bank in the world, every major central bank in the world has some sort of easy money policy. And the global economy, it's not just a Fed problem, it's a global problem. The global economy is not responding well to all this easy money that's sloshing around the globe.
Adam, one thing.
It's almost like a law of so go ahead.
One thing we've talked about, on the show consistently, as the reason this market really doesn't, really fall out of bed is there's a lot of sector rotation. If they're selling something, they're buying something else, and that provides a buoyancy to the market. You can see the rotation in and out of the momos. But Rob Hood, let's concentrate here on the steel sector and STLD, that's Steel Dynamics. Taking a look at the chart, the issue. This one's acted, pretty good here. It's had a little bit of a rally. So let's just talk about the steel sector in general, Steel Dynamics, and then let's also, touch on the biggest one, U.S. Steel, Nucor, and maybe AKS.
Sure, absolutely. I think the steel in general it's almost like copper, where it used to serve as a good proxy for the global economy. So what does that mean? As the economy grows, people needed more steel and copper to use to build stuff, for lack of a better way of explaining it, right?
Mm-hmm.
So what's happened, that the economy shifted dramatically over the last 20 or 30 years. Now we've entered the information age, if you will. So if you look at the history of the global economy for a second, it started off with agriculture as being the primary driver of the global economy for years and years and years, right? Then all of a sudden you had the Industrial Revolution, and then the world shifted to physical goods, and then agriculture took a back seat. Then you had the service explosion going on during most of the 1900s. Then the economy shifted to be more of a service type of a thing. It was a 50-50 split, then it was a 70-30 split, and then it became more services. But over the last 20 or 30 years, now in the age of information. We're in the dawn of this age of information. And what does that mean? Information is your most valuable asset, or commodity, rather. I like to say time is your most valuable asset, and information is your most valuable commodity on the planet. So when you look at steel stocks or you look at copper in general, and you say, okay, well, what are these? How important are these stocks to the global economy? The reality is, in today's world, where you have the biggest companies in the world literally selling information, or that's what their asset is. Look at Uber, $50 billion valuation. They don't use steel; they use technology. Google, they don't use steel. Facebook, Twitter, go on and on and on. Right, the biggest players in today's world. So as the economy shifts, and we look at, our business, for example, financial services. They don't use steel. We're selling information to help people make more informed or better investment decisions. And that's why our clients come to us. It's that simple. Now, when you look at steel, is it as important as it once was? The answer is no. But it still is important because no matter what, if you're going to build or expand in any city anywhere in the world, you have to use steel to do that. And that's why these steel stocks continue to, they've been under pressure for a long time, but they're starting to turn around again because as all this easy money from central banks in the world being reinvested into core assets or physical assets, and these cities are rebuilding or resurfacing or even upgrading a lot of the infrastructure, steel comes back into play. So if you go back, STLD, stock hasn't really gone anywhere since '08. Back in 2008, the high, actually, it's really still way below its '08 highs. The high in 2008 was, $40? Now we're at 22. So it's, as the market took off over the last 6 years, steel, this company, other stocks also, U.S. Steel or whatever it is that you want to use, they really haven't participated. Look at ticker symbol X. The '08 high was, 196, and now we're at $25.
Yeah,
So that's where it's like, okay, a lot of the whole sector, the steel sector, it hasn't really been a leading area. But to speak to your point about the sector rotation, the reason why the major averages are acting so well, even though the transport are under pressure or steel, gaming stocks, there's a lot of bearish areas or just areas that are not acting well right now, is that something I call the great mini rotation. People talk about the great rotation from bonds to stocks and all that fun stuff, or stocks to bonds. Under the surface, that sector rotation we've seen over the last 4 or 5 years now is every time one leading sector gets in trouble, almost instantly another sector shows up. The money is just moving to another area. And that's why the market continues to rally, and I call that the great mini rotation. So under the surface, a lot of these sectors, that heavy rotation from one asset class to another, right now biotechs and semiconductors are really, really hot. Okay, gaming's not so hot, steel's not so hot. But if all of a sudden steel and other commodities start turning around, boom. That's how the market continues to go higher, even though under the surface you're seeing a lot of rotation. Does that help answer the question?
Yeah, so I mean, so you're, the global economy is okay here. So buy, sell, or hold here. The U.S. Steel, $25, $26.
I would say if you are not involved, I wouldn't buy it right now. But if the stock starts moving and breaks out above the recent highs, above 27.68 or $28,
Okay.
maybe take a look at it. If you're aggressive or if you're bullish on steel itself, as hey, I need to buy steel stocks because the group is going higher, then by all means you can buy it here with an exit right below this week's low because it's getting above the 50-day moving average and the 10-day and 21-day. So, X itself, I wouldn't touch the space right now. I would want to see more confirmation to the upside. I like to buy leaders, and this is not a leading area right now. If it becomes a leading group or if we start seeing some money move into it, then that'll definitely catch my attention.
Yeah, I'd kind of
Gold, sorry.
No, that's great. Just kind of fighting the market. I can see what you're saying here. You're fighting a trend here. If it emerges as a trend based on your technical analysis parameters, then you'll get interested with defined entry and exit points. So that's great advice from Adam Sarhan, a very knowledgeable guest, founder and CEO of Sarhan Capital. Great on the markets. Love having you on. Hope to get you on again soon, Adam.
Oh, it's a pleasure. Thank you.